Hello and welcome to this week's episode of the Scottish Property Podcast. My name is Stephen Clark and I'm joined as always with Nick Ponty. How are you, Nick?
How you doing, mate? I've only got 2 minutes to do this because I'm having to go at the paddling pool. So,
Oh yes, we're recording on the day that's going to be the hottest day of the year. It's going to hit 36 degrees.
hottest day of the year.
Yeah, absolutely. Today's interview we've got on was actually a fantastic interview with Josh Tharby from JSM Accountancy. So I followed Josh for about a year on Instagram, and he's not your typical accountant, shirt and tie and an office stuffy. He puts himself out there on social media. He delivers, he adds value, he answers questions, he kind of thinks on the tax efficiencies of limited companies who specialise in property investing. So it was just a nice, really good chat. But there was so much tips and value from everyone in this interview, starting out to get the right structure in place and what to do for your accountants going forward, but also he goes into detail as well about how to save tax to earn over the £50,000 a year from your limited company and what expenses you can put in from your household expenses to your cars and what cars you can put through. So it was phenomenal value. Really good interview.
Great stuff. I'm looking forward to listening to this one back. So we'll just cut to the interview with Joshua. Here we go.
Welcome to the Scottish Property Podcast, Josh Tharby from JSM Partners. Thanks very much for joining us.
Yeah, my pleasure. Thank you very much for having me on here today.
So yeah, I've followed you on Instagram for quite a while because you know what it's like. You want to have the people around you and in your mind space that provides some kind of value to your life. And you are one that I've followed for probably about a year actually. Because I kind of find so you're an accountant to trade and you've got an accountancy firm, but you actually are a normal, approachable person, which is quite very unique in the accountancy world, isn't it?
Yeah, 100%. Accountancy, it's one of those spaces where it's got that kind of stereotype to it where you're locked in a room, you love playing with Excels, and to some part that is true. Is in to actually do the nitty gritty work, you have to be that kind of person where you might enjoy sitting in front of a computer all day rather than being out there speaking to people. But that's kind of what's allowed our company to thrive. Is that I started the business, so I'm an accountant, but I'm also an entrepreneur and property investor first. But I just so happen to be a qualified accountant and tax advisor. So that all kind of feeds down, and that's allowed us to do things differently to other accountants and give better value.
And you touched on the other as well, mate, which I think is really so important when property professionals are looking for these people on their team. Is you're a property investor, so you get it's easy enough to sit behind a laptop and understand a business point of view, but property businesses are so unique. So you as a property investor could provide a whole lot of value to your clients. Can you talk us a little bit about your kind of property experience and background and your own property?
Yeah, absolutely. So it is very important to be working with an accountant, because even when we're speaking with people that are just new in property, so where we're adding value, it's not just set up a limited company, do this, use zero. It's actually we're going to talk to you about return on capital. Should you be investing where you are potentially, and actually just giving them access to my personal experience, and it's actually going to help them. Before we're speaking to somebody in there, by the time we ran through one of the deals that they were considering putting a load of money into it, it was kind of like a 4% return. And they didn't even realize this because they were new into property. Mm-hmm. So in terms of what I've done, I kind of dabbled in BRR, done a flip or so. But now what we're focusing on is the larger deals, because what we found out is that, we can sit there scouring all the portals, speaking with agents, and basically spending a lot of time looking for deals, which we have to do if you want to be successful in property. But we've also got other trading businesses as well that cash flow and do require attention. So what we've done now is we've changed our strategic shift so that we don't just basically go for the smaller single let deals. We are literally focusing on the larger apartment blocks, because that allows us to basically, you do get a pretty good return on them as well. And it allows us to focus on the larger businesses and just invest that money into property, because that's what we've noticed. If you actually want to build serious long-term wealth, that's one of the ways to do it. You need some way to generate cash flow, such as a trading business or in property as well. You might be doing flipping, deal packaging, some way that you're basically going to make money. And then property is basically the store of value. So you invest it from your cash flow business into property, and then that's where you're going to have rental income, capital growth, and then you basically keep doing that. And over time, your personal balance sheet will just explode.
Yeah, and you'll see that from your hundreds of clients. You'll be able to look at obviously all their businesses, look at what works and what doesn't work. So be able to tweak accordingly as well, I'm assuming.
Yeah, absolutely. So literally looking at what works for clients. Okay, so what are they doing? They've got this, and then they're doing that. Not even just clients, they're kind of going up a level from that. So looking at Sunday Times rich list, what are these people doing actually on a different level? Kind of, so they've pretty much all got trading businesses, and they've all started buying large properties. Even kind of Grant Cardone, for instance, he buys literally the big apartment blocks rather than single lets. And I thought, okay, they must be onto something here. So kind of looking at why they're doing it, understanding the reasons, and seeing if that makes sense to me. And actually, it did. So that
Alan Sugar's probably one of the well-known
Yeah.
ones as well. Like, I mean, he, his business was all built in it was at Amstrad and computer trading, and all of the money he made in these companies seemed to have got piled into his London property portfolio. And what they've taken £390 million dividends last year from his company. Like,
that'd be nice.
Long-term wealth can be built from property, but you need to have that cash flow. So when you do your own stuff, then do you just go to sourcers to then kind of secure the deals for you rather than you wasting your time or using time?
Sources. We have alerts set up on all the portals still. Occasionally, if I'm kind of just sitting there bored in the evening or something like that, I've got 5-10 minutes, I just have a look through. But yeah, literally, it's usually just sources, agents know what we're looking for, and then the Rightmove and Zoopla alerts as well.
No, that's good, man. That's good to see experience, in property as an accountant as well. That is really, really, really good.
I wanted to ask you, obviously as an accountant, you've have seen over the last couple of years, obviously with the pandemic and all that, you guys were kept pretty busy with all the changes that kept coming in. And I know you put out a lot of content with all the loans and, packages and all that the government kept coming out with. But, there was a lot of basically free money kicking about. But how's that kind of impacted businesses now? Was that a good thing? Was there any negatives to that? I mean, in terms of the bounce back loans and things like that, I was worried that, it was going to have an impact on my kind of lending ability. That's more probably a question for a mortgage advisor. But did you see any problems resulting from all that all those handouts?
Yes, I suppose from my experience, it can have an impact on the mortgages. So this is about probably about a year ago when we was looking to buy a property. Basically, they wanted to know about all the bounce back loans, and some lenders didn't like it. So they did reduce availability. That's about a year ago, but now they are asking it. So when we're filling out accountants' references, where they usually just ask what the net profit is to basically apply for a mortgage, now they're asking, okay, what's the bounce back loan? What's the term? How much is the repayments? All those kind of extra details. So it can impact it. Whether it was a good thing, I guess, now we're in a ridiculously high inflationary environment. The reason for that is because they've just made all this money out of thin air from all this COVID support. So I guess that's the downside to it, is that's the reason things are kind of ridiculously expensive at the minute, is because all of this money has just been created and given to people, literally kind of bounce back loans, all the coronavirus job support stuff. So that's what's kind of had the impact on that perspective. From an accounts and tax point of view, I guess the biggest downside is that taxes are going up, so that they can repay this loan and start to service all the government borrowing. Taxes are going from next year. Corporation tax is going up from 19% to basically there's going to be a 26.5% rate that kicks in. So I'll go into this in a little bit of detail now. So essentially from next year onwards, where you've got a limited company, profits of up to £50,000 will be taxed at 19%. Any profits between £50,000 and £250,000 will be taxed at 26.5%. And then profits over 250 will be taxed at 25%. And that £50,000 small profits allowance, that gets divided by the total number of companies that you own and control. So if you've got 2 or 3 different companies, that's going to be kind of about £15,000, £16,000 per each company. So you're actually going to have a lot of your profits taxed at 26.5%, which is a massive increase for a lot of owners, a lot of businesses, plus the dividend tax increase as well, national insurance. So this is really the bad thing that's come out of all of the coronavirus stuff.
See the £50,000. I've heard that's going to get put about quite a bit from next year, isn't it? See if you've got a joint venture with a partner in one company, but you've got 5, 6, 10 companies externally, but your partner's only got one. How is that profit then treated in the one company you've got with your joint venture partner? Because surely it's a bit unfair if you're getting only £5,000 allowance at the lower rate and your other partner's got just the one company that should be able to get the £50,000 allowance?
So that one, it basically depends on how many companies you control. So if that joint venture was 50-50, technically you wouldn't control it because you'd need more than 50% to control it, which would mean that company would get its full £50,000 small profits threshold. And then all of your 10 companies, you'd basically get £5,000 per each company. So the vast majority of your profits would get taxed at that 26.5% rate.
Right, so 50-50 ones will get taxed or will get the full £50,000 allowance because you don't.
Yeah, it's basically companies under your control. So if it is, or if you had, say for instance, it was a JV, but it was 60-40 in your favor, you would control that. So as a result, it would get included in that division.
Will that give a loophole for joint ventures to kind of be more tax efficient, going 50-50 rather than having it in the control of someone else?
100%. Yeah, that would be a factor when structuring a JV. Okay, how many other companies do you have? Because if you've got, so you were to split that 25,000, it's a couple of £1,000 extra tax at least, just by structuring it that right way.
So this is the hot topic of the moment, isn't it, with the leadership debate? So, some of them are coming out and saying, no, they're going to reduce taxes and all the rest of it. Then I think you've got like Rishi's coming out and saying, no, it's got to be, we've got to power ahead with these tax increases because, basically we've got to reduce the deficit and all the rest of it. Like, it's quite a hot topic. But I mean, these guys that are coming out and saying we're going to cut taxes, I mean, you can't just magic money out of thin air. So public services and all the rest of it have got to be paid somehow. So I just think that's just kicking the can down the road, doesn't it? It's just going to cause more problems later down the line.
Yeah, well, that's ultimately kind of what they try to do. Essentially, that's why the government borrow just increases because they do just kick the can down the road for a large part. But yeah, taxes do have to increase because the government borrowing's kind of ridiculously high, especially with all this COVID stuff. Even just them paying the interest on it, they need taxes just to service the debt, let alone actually repay it as well. So taxes do have to go up, but it's just kind of finding the right balance as to where and how, because people like basically wealthy people, they don't stay in England. I saw a post, I think it was on Time, somewhere like that, where in the past couple of years, 12,000 what they call wealthy people, which are people with assets of £1 million or more, have left the UK, and one main factor of that is tax.
No, absolutely, yeah. You see that quite a lot, don't you? People try and go offshore accounts and stuff like that. Can you invest in property in the UK with a UK limited company if you're abroad, or you still have to pay tax, like corporation tax in the UK?
So you still have to pay UK corporation tax, but you can do it. So because UK property, when I've looked at other property markets, Dubai, for instance, when I looked into quite a bit, UK property still makes a lot more sense than investing in Dubai. But what would happen is if you were to have a UK company that invests in UK property, you'll pay corporation tax at 19%, for instance. But then if you were personally living in Dubai, where there's zero income taxes, you could take all of your dividend income out completely tax-free.
That's interesting, yeah. And if the company was set up out with the UK, can it still purchase property in the UK then?
Yeah, so you can have an overseas company that purchases UK property, but because the property's in the UK, HMRC are always going to tax it because the property is located in the UK. That's how they want to tax it. But for instance, if you did want to invest in overseas property, if you invest in property in Dubai where there's no tax and lived in Dubai with a Dubai company, they would all be tax-free.
That's interesting. Is it something you've looked at personally, investing abroad, investing in Dubai?
Yeah, I've actually got a visa for Dubai. We've got a company set up over there as well, just because we're kind of testing the waters at the minute, whether we're going to move there in the next 3 to 5 years. And to be honest, the primary factor behind that is the tax aspects in the UK, because especially when you kind of if you want to basically have a really good lifestyle, I calculated and my tax rate is over 50%. And you actually think, what's that really going towards? You can't really get good hospital appointments. Doctors have got massively long waiting lists, so you're paying for private anyway. And then, crime is ridiculously high in most places. When is it, not that I'm promoting Dubai all the time, but Dubai, you don't really have any of that. It's ridiculously safe. There's no taxes. So it's a really, really attractive place to look at relocating.
You touched on that quite a bit there as well, the tax. When you look at your tax position, you're paying over 50%, because we're talking about tax, and you know, in limited companies at 25%, but that's not where the buck stops, is it? You've still got to get the money out of your limited companies to pay yourself personally, and that's where, like you say, it's going to go over 50%.
Yeah, that's where it really adds up. So you can take about £50,000 out of a limited company pretty tax efficiently. You'll pay about an extra 10% in tax. So realistically, your average tax rate will be about 30%. But when you want to go above that, especially to about £100,000, you know, you're looking at about 50%. And if you want to go even more than that, it can really touch up to 55, potentially 60% in some cases. And then, you know, realistically, we don't all want to be working as hard as we do just to be taking £50,000 a year. You know, we want to work hard to be taking $250,000, $500,000 a year. That's where we want to get to. And if you think you're doing that and then giving HMRC the best part of half, even if you think, okay, I have to relocate to Dubai, the tax savings alone would pay for a fantastic lifestyle there, and you've still got your £250,000.
Well, that was going to be my one main question actually for you on this podcast, was the same thing, because, you know, as you know, even personally, I know a lot of the listeners will be in the exact same boat. As you're investing in growing assets in a limited company, you are taking, I think it's 43 in Scotland and 50 for the UK tax. But do you think, you know, we take that? I mean, I don't know if I can go into details, not being the tax accountant, but I know personally I'll take out the minimum, you know, salary without national insurance, then the rest will be up the 7.5% dividend. So that's okay when you're well and good, when you're still growing your assets and your property portfolio. But exactly like you say, what happens when you go right? Fuck it, I've stopped acquiring assets. My business is where I want it to be now. I want to go and try and take 200, 300 grand a year out of this company.
Yeah,
I take it. There's, because I know you're quite prolific in saying how you can do it efficiently. It sounds like I'm answering one question, or you've answered it. Piss off to Dubai is probably the best answer for that.
well, yeah, realistically, if you're in the UK, you're still, even with numbers like that, if you were talking $250,000, for instance, the most efficient one would still be that small salary of kind of about 11,900, whatever it is this year, and then just top it up in dividends. Yeah. But what will happen is you'll lose your personal allowance. You can actually get as soon as your income goes over £100,000, for every £2 of income, you basically lose £1 of your personal allowance.
Yeah.
So you don't get your tax-free allowance anymore. And the vast majority of those dividends are going to be taxed at 39.35%. And then you've already paid corporation tax on them as well. So the actual tax hit on a lot of that money is going to be, even if you were to take out 1,300,000, you'd probably be left with 150, maybe 175 of that maximum.
Is this where you'd have huge expenses to the company that could be offset against the corporation tax? Like I don't know what cars you could buy, or what type, you know, what other kind of big liabilities I suppose you can buy in the company that would save you taking the money out and buying it personally. Is that how you would?
Yeah, that's absolutely one way of it. So the biggest example, kind of speaking personally as well, is a car. You know, car's probably one of the second or third biggest expense you actually pay really after accommodation. So if you can get that going through your company, then that's a tax efficient move. But you've got to make sure that you don't basically, if you were to put a kind of really, a Range Rover SVR, for instance, the government still don't want people driving these high emission vehicles. So the company car tax you pay, where your company pays for that car and provides it to you to use personally, is ridiculously high. It's literally 37%.
That's the benefit in kind.
Yeah, the benefit in kind. So it makes sense to do it, but then you've got to be kind of selective as to what car you get. You can only really get an electric car or a hybrid. If not, you'll end up paying more tax than you're saving.
Yeah. I bought the Tesla Performance, the limited company, as well, because it just went to 1%, I think, or it went to 2%. It was
£8 2%. So electric cars, ridiculously tax efficient.
Yeah. But then I suppose that when I looked at that just recently, I'm thinking, okay, what's the next step? Is you'd go and get that Porsche Taycan or something like that through the company at 120 grand. But then, how often do you keep spending, electric vehicles in the car before you're like, fuck, I don't want any more cars. I want
the trouble with that as well is the Porsche Taycans, at the minute I was speaking to them, I think they've got 1 or 2 year lead time.
Yeah. Well, it's funny you touched on the cars, because I was trying to find a creative way of getting the Porsche 911 GTS through the company. Yeah. And it was the same thing. You were just looking at going, like, doing all the calculations, going, it's not tax efficient to put it through.
There is a tax efficient way, but it doesn't involve a company. So this is typically where the limited liability partnerships, the LLPs, come into it. So if you've got a trading business, and typically an LLP, for instance, so you still get the benefit of limited liability, and you've got a Porsche 911, which is costing you, say, all in with insurance, fuel, the lot, say £2,000 a month. If you basically use that car for instance, for 50% business purposes, then in an LLP, you can claim 50% of that cost as a tax deduction. So it works completely different to a normal limited company where you have to pay the benefit in kind, where your company provides you a car. With an LLP, you don't have that. It's basically just, is it an allowable expense or not? So what you can do is, if you do want a kind of really expensive cars like that, if you've got some kind of business or whatever business you're going to be using that car for, whether it's kind of meeting clients, if you've got a consultancy, your trading business, mentorship, if you put that into an LLP potentially, and then you're using that car for business travel, 50% of it or 60%, whatever it might be, you can justify as a business expense, will come off of your LLP profits and you'll get tax relief there.
See that, guys? This is why you listen to this podcast. That's a great bit of tax advice that. If only I'd listened to that 6 months ago. But you know, touching on that the salary thing as well, which was quite funny, because I kind of wanted the 911 as an investment as well, something to park in the garage and have long term. So I put the finance on HP. But what I thought was hilarious was the Porsche garage for the remaining bit. I mean, I put in a pretty fucking chunky deposit. The Porsche garage were saying, you know, for the finance, you've got to earn over 100 grand a year. No, that's kind of shit. And I was like, going, what business owners are going to take 100 grand a year as a salary, because you're going to get hammered with tax? So
yeah,
when I said that, you know, he didn't batter an eyelid. So it's obviously quite a common thing that business owners will take out the 50 grand up to the allowance. And then, you know, all did say the back of that was, Jeff, you can just prove you're a high net worth individual. We can give you the finance, which was easy enough. It was pretty basic and easy enough to do it and show your portfolio schedule and stuff like that. But I found that quite interesting as well, because it was like, I'm assuming that option was up there in case, you know, an employee on PAYE was earning over 150 grand, could go and get finance on this type of car. But business owners was, you know, it was obviously quite a common thing to say, well, okay, the business owner's not going to take more than 50 grand out of it, but they've got, you know, a lot of profit in their company and they've got a high net worth. Is that quite common?
Yeah, absolutely. Quite, especially a lot of people, they say about that £50,000. So even some clients, when we speak to them, it's kind of, they just physically, no matter kind of how much I say to them, you know, if you want to make money and actually live the lifestyle you want, that you kind of deserve, and you're working towards as a business owner, you do have to accept that sometimes basically the only way to do that is to become a higher rate taxpayer to pay that tax bill. But a lot of people do get stuck in this trap. Actually, I don't want to go above more than £50,000. I don't want to pay the 30%. But what they're actually kind of doing there is they're losing the extra 70%, and they're just kind of staying in that trap, kind of living small. Whereas ultimately, like you mentioned, Alan Sugar took 380 million in dividends. Kind of tax isn't tax is a problem, and tax is a big expense. So do what you can to minimize it. But if you can't afford that tax bill, you've not got a tax problem, you've got an earnings problem. So rather than focusing on, okay, I don't want to pay that tax bill, I want to stay small, focus on actually how can I make so much more money that I don't care about the tax bill. Because ultimately that's what you want to do. That's why you start a business, because you do want that different lifestyle. So a lot of people do get stuck in that kind of £50,000 area, and for whatever reason don't want to pay more tax than that, but as a result kind of shoot themselves in the foot long term.
Yeah, no, I find that quite a lot with this. So the people I speak to is kind of, they're stuck at that level. They're going, I don't want to earn more than 50,000 through the limited company. They'll keep it building the limited company and play the corporation tax. But then effectively, if you've not got SASs and stuff you can pump in to get the money out, then you're going to have to pay it at some point, which means like, and you hit the nail on the head. It's just going to fine tune your mindset to think smaller and not earn. Not
and a lot of people as well. You know, they might be doing this. They might even have kind of some examples. They might even have children. So they're literally doing this kind of 30, 40, 50 years old, still kind of doing this 50,000, building it up. But then there's no kind of end in sight. They're just building it up, taking the 50,000, and you know, you can just drop dead tomorrow. So there's got to be an element of it where actually you do enjoy some of what you're doing now, because you know tomorrow isn't guaranteed by any means. So rather than just, okay, 50,000, we might take some more in 10 years time. If your business is at that level and you've reinvested a lot of your profits, and you've got a lot of free cash flow and you do want to enjoy it, you know, a lot of the time you probably should consider actually, you know what, just pull it out and pay the tax.
Yeah, absolutely. And you mentioned some other, like you mentioned the car being like the third biggest expense you will buy that you can offset through a company. What's other big ones that you could tax efficiently put through the company?
So yeah, cars. Other potential things might be travel. So if you are doing a kind of lot of business overseas, that's a good thing about kind of masterminds, overseas retreats, things like that. Is, you know, if you want to go to Spain, Dubai, Marbella, or wherever the retreat is, that's a big one. As long as you can show that it's a valid business trip and you go in there, there's kind of very limited personal enjoyment because you've got a good itinerary, even if it's viewing properties with agents, things like that. As long as you've got a good itinerary you can put together, that overseas trip you can put through your company accounts and basically have it tax-free.
And I'm assuming this would only be ever looked into if HMRC investigated and asked what was the purpose of that trip, and you could prove it. Would you need to just go and dig back evidence? I take it you'd advise your clients to kind of put together some evidence just in the foresight that HMRC might investigate that trip or question that trip.
Yeah, absolutely. So yes, it's only if HMRC ever do investigate. I mean, the chances of that are possible to say. They're quite busy at the minute with all the kind of furlough scheme still. I've seen some instances of HMRC taking a year to literally reply to a letter. So whether they're doing kind of these kind of inquiries, who knows? But yeah, just kind of keeping that one there on file so that if, you know, a couple of years later they do come, okay, what was this trip for? You can show them and persuade them that it is an allowable business expense.
No, that makes sense. Because if you have a partner, a wife that isn't working in a limited company, I'm assuming that's more difficult to then put through.
That would be. So what you would have to do there is look to see if you could make them an employee so that they had to be on that trip as well. But if, for instance, they weren't employed by the company at all, you're probably better off paying for their travel separately.
Yeah.
Because you wouldn't be able to claim that unless they had to be on the trip with you.
No, that makes sense. And any other big expenses you could put through a limited company off the top of your head?
Yeah, so another big one is using your home as office. So a lot of people, you know, most £6 flat rate, but realistically, you know, with the household bills as they are at the minute, that's nowhere near touching it. So a lot of people have probably got one or two kind of rooms in their house that they use pretty much exclusively for business. So what you can do in this case is if you've got, say, a 4 or 5 bedroom house, you can add up the total number of rooms that you've got, and then whichever rooms you use for business, you can basically claim a proportion of your household running expenses. So mortgage, interest, gas, electricity, water, the whole lot. And usually that amounts to, you know, probably a couple of £1,000 a year rather than the 312 flat rate. So that's a big one. And what that does is, because you've already incurred and paid for that expense personally, that's going to go to your director's loan account, which is extra money that the company can pay you tax-free. And it's going to be recorded as an expense in the company accounts, which is going to lower the amount of corporation tax. So it's kind of a win-win there, in that you're paying less company tax and you've got more cash available to go to your pocket.
And that's is that right with like your mileage expenses and stuff like that as well, like your 45p a mile, build that up, that's when you take the payment and it comes back to you tax free at the end of the year.
Exactly the same as that. So yeah, mileage is another great one for a lot of people that are using their own car. You know, mileage is a massive expense. 10,000 miles at 45p, that's £4,500 a year, which will save you £900 in corporation tax. And it basically save you a couple of £100 in income tax as well, because you're able to pull £4,500 out tax-free.
Yeah. Do you need to keep a mileage log at all for that then, for those business mileage that you're doing? Is there an easy way of doing that?
Yeah, it's best to keep a log, again, just in case HMRC come along and ask some questions. You can literally do Excel, paper, there's apps such as Mile IQ and Trip Catcher, and they basically track your GPS location. You just log whether it's a business trip or not, and they keep it all digital for you. There's no right or wrong way, it's just whatever works best for you.
Yeah, that's always put me off doing it as well. It's that capability of tracking each drive in case you do get investigated as well. Yeah. And I touch on that kind of mileage thing. What about electric cars then? Is electric cars any different on the way they're charged?
So at the minute, if it's a private car, there's no difference. It's still the 45p that you can claim. If it's a company car, it's completely different because all the expenses are all recognised in the company already. So, but if you do have an electric car that you own personally that you're using for business, you can still claim that 45p a mile, which, you know, that should be a decent profit because of how cheap the electric cars are to run.
No, that's a good point actually. Yeah, and you get any benefits off charging it from your home as well?
So yeah, if it's a business car, so if it's a company-owned car that you charge at home, then you can claim the cost of charging it in the company accounts. So if you look at most electric cars have all got apps these days that tell you how many kilowatts it was. So if you can look at how much you're paying for electricity, whether that's 30, 40p a kilowatt, and then it's taking you 20 kilowatts to charge it overnight, your company can reimburse you for that expense, same way as you do for mileage and all the director's loan account transactions.
This has turned into a podcast on how to tax efficiently run your company, isn't it?
Yeah, exactly.
No, I appreciate that. It's interesting because I touched on this just before we started recording as well. Like, I always find that with accountants is they're not very forthcoming in giving you this information up front, which obviously you are on your social media. So if anybody's wanting this kind of advice, constantly follow Josh on Instagram. But yeah, it's something that as you grow, you try and mitigate tax and you try and figure it out rather than get it offered to you. Try and come up with creative ways of doing it. So to get it from the listener's point of view, to get it from me asking these questions is great, because brilliant, take note of that, take note of this. I want to touch on something else on structures, like kind of structures, group structures around more property businesses, because I'm assuming at different levels that you can kind of combine a lot, but certainly as you're growing, a lot of lenders won't let you doing trading activities, flips, sourcing, anything else in a company that owns residential property. It's class an investment. So if you got any kind of client guidelines that you give to your clients on what structure is the best, growth, do you know what it's like? You always kind of you want to start off with the end in mind, but often people don't know where the end in mind is. But maybe to have this conversation up front, something might trigger them and think, oh shit, yeah, I wanted to add that in the business at some point in the future. So let's set that up now, if that makes sense.
Yeah, absolutely. So there's a couple of different aspects to it. So you touched on the finance side of it there, then the kind of tax links in with it as well. So even doing a flip where you want to do it for an investment company, a lot of lenders don't like that. So they'll look at what SIC codes you might have used. If they look at the accounts and see there's flips gone through there, that can actually limit your choice of lenders. I've had it before where it was a company that previously had a non-property SIC code, and they just said not going to lend to it. They want a fresh SPV set up if they're going to lend. So that's kind of one factor that goes into it. And then you've got the tax side of it, in that if you're doing property trading, that's treated differently to property investment. So if you're doing a serviced accommodation, flips, development, that isn't treated as property investment. You get a lot of tax benefits to that. You can wind the company up and basically pay entrepreneurs relief, business asset disposal relief, which means you pay 10% on putting the money out. You can potentially get gift holdover relief. There's all these other mechanisms that are available that make it that property activity tax efficient. And then you've got property investment, buy-to-let, HMOs, buying and holding property. That isn't tax favored at all. The government don't like that. So as a result, there's no tax benefits. But what can happen is if you mix the two together, you'll lose the benefits because they all get blended into one company and tainted. And you basically lose what would have been available if you would have kept them separate. So where possible, we always say try to separate out each activity. So if you've got buy-to-let, keep that separate. If you've got service accommodation, keep that separate. But then even the tax and the finance side, the legal side as well. Service accommodation is a risky business. If for whatever reason something goes wrong, you're underinsured, would you really want all of your assets, your long-term assets, sitting in that same company where they're exposed? Things happen. I think I saw literally on Facebook in a group the other day about how a landlord had basically been using the property as buy-to-let, so it was insured under buy-to-let. He started using it as service accommodation, but didn't change his insurance over. So he let it out. Somebody smoked in the apartment, it caught fire and burnt down, and the insurance didn't pay out because he had the wrong type of insurance. So if you were to kind of think that kind of thing can happen, and if that happened in your business, you'd want to have some of it separated out. So if you had all your eggs in one basket, you've actually now got to basically pay to get that property sorted out, repay the mortgage. It's going to be very, very damaging. Whereas at least if you were to separate it out, you would have some benefit of the limited liability, and at least some of your assets would have been safe. So always look to separate out where possible.
Yeah, no, that's a great piece of advice, actually. Yeah, quite a scary story as well, like you say, but it's a good realistic point to actually put that across, to say this is the shit that could happen, and you want to try and protect your businesses and yourself as much as possible. Even
with buy-to-let, for whatever reason, it's difficult to say, but whether a landlord could be negligent, the different kind of scales, if you don't do the right check on your plumber, who's you don't check whether his gas safety registered, then all of a sudden there's a gas leak at the property, but you arrange that, Like, could you be held liable for that if you basically, killed too many tenants, gave them gas poisoning? Property investment can be risky. So that's why separating it out, even with some clients, they have 5 properties in one company and then another company for the next 5 properties as well, just so that their whole portfolio isn't potentially at risk in one company.
Yeah, no, that makes sense. So as kind of property business owners, it's quite easy to dabble in different business types in property, whether it be buy to let, flips, SA, HMO, commercial, residential development, stuff like that. So if you were having multiple companies, would you advise your clients to just hold the shareholdings of the companies completely, or would you put them in some kind of group structure?
Yeah, so a group structure is good depending on what you're looking to achieve. So if you're basically just starting out in buy to let and you don't know what you're going to do, you might want to buy 1 or 2 properties, then probably not. The main benefits of a group structure are that you can move assets and cash around pretty tax efficiently, and it helps reduce risk. So a classic example of where a group structure is literally perfect is you've got a trading business, so you've got a large cash flowing business, and you want to use the excess cash flow each month to invest in property. If you didn't have a group structure, you would basically have to pull it out personally or loan it from the trading business to the investment company, which over time it's going to build up. There could be tax issues there. Whereas if you had a holding company, you can just move it around tax free, and then it's out of risk in the trading business. So if anything goes wrong in there, it's separate, and then you can move it to the investment company tax free and use it to buy property. So if you are looking at doing the kind of lumpier cash flow deals where you might do a development, or you might do kind of something where you're going to reinvest a lot of the cash flow, then that's where a group structure is going to be good. If you're going to basically kind of just have a buy-to-let property portfolio but not do anything else, there's not going to be any benefit to it there really. So then you've got to balance the cost of actually getting the group structure set up from day one, because it might be 5 years' time before you're actually in a position where you actually benefit from it. So that's where you've got to balance the kind of the cost to benefit analysis there to make sure that actually, it's actually going to pay off in the long run.
So, and what's the cost associated with a group structure? Then I'm assuming just more.
More companies, more accountancy fees. That's it. More admin, kind of keeping on top of it all. But that's the only downside. And for some people, lending is still a little bit more difficult as well. So especially if you're a new landlord, you don't own your main residence. If you kind of fall outside of the wider lender criteria, if you would have a group structure in place, then it can be more difficult.
I think that just reduces the amount of lenders that are available to you.
And even if it reduces it, but actually increases your finance cost by 1%, that's when you've got, 1% could be a very, very real increase to any potential tax savings. So for some people, it's probably better off starting out with one company, and then a group structure can be added later on. So when, 3 or 4 years time, when you've actually got that portfolio, you've got the landlord experience, you can open yourself up to the full panel of lenders, then we can look to put a group structure in, because it can be done at a later date, and then you can basically start benefiting from it.
What's the cost implications of doing it at a later date then? I'm assuming because then the company would have value and your shares would have value to pass into a group structure. Would you pay capital gains tax on that, or? Yeah,
so essentially there would be tax, but what we can do is you can do something called a share for share exchange, and it basically involves just running to HMRC, getting clearance, and then the end result is we can do it tax free. But from an accountancy point of view, you're probably looking at anywhere between £2,000 to £3,000 to get that set up at a later date.
All right, so it could make sense to do it at a later date rather than too early on and end up paying thousands of pounds. Might not necessarily not happen, but that's quite
we always say to clients and anybody we speak to really is often when people go on a training course, they basically get really kind of happy. They start saying, okay, we're going to set up this company here, this company here, this company here, and what happens is they lose track of them all for one. So they get fines and penalties because they're not appointed accountant, and even if they have appointed an accountant, they're not doing those three. They're not using them all to what they should be. So when just starting up, just kind of keep it as simple as possible. Just have the one company, get traction on that before you've kind of set up the second, third, fourth company, because if not, you're just going to cost yourself money in the long run. Yeah, no, that's a really good bit of advice actually, because people can kind of get full off the rah-rah and very, very motivated quite quickly for a few days of training, and then go, right, let's go and set up. Go on company's house, see it costs £12 or whatever it is to set up a company. Okay, we'll set up 1, set up 2, set up 3. But actually, it's going to cost money to get the accounts and corporation tax done. And that's assuming you don't forget about it, because, you know, a lot of clients, well, not clients, but a lot of people come to us and say, oh, well, I've completely forgot about this. And as soon as your corporation tax return is late, even by a day, that's £100. Your accounts are £150 for being late. And all of those penalties increase as well, depending on how late the accounts and corporation tax return are. So that's probably the biggest expense. Is it's quite easy to forget about the filing and the dates when you've got a number of companies.
And that's your legal responsibility as the director of the company, isn't it?
Yeah, exactly. As a director, that's your legal duty, is to stay on top of all of that stuff.
No, that's really valuable. I'm pretty sure people listening to this that are at different stages of their journey, but which have kind of covered quite a bit from starting out to the more experienced ones, and even talking about the group structure and tax efficiencies. That's that's phenomenal. Honestly, I'm cautious taking up too much of your time. I just quickly, where could the listeners reach out to you if they want to get in touch? I'm trying to think of other questions I had before we wrap up.
Yeah, so pretty much anywhere. So we've got a YouTube channel, Instagram, Facebook. So all of that is just at Joshua Tharby. The website, jsmpartners.co.uk. And if anybody wants to email me, it's joshua@jsmpartners.co.uk.
Right, mate. And what's the plan for you for the future? Then you touched on Dubai, you touched on obviously you're young and you're thinking bigger as well. You're not want to just do this for a 50 grand basic salary. You want to go high. What's your plans and goals?
Okay, yeah. So the kind of big goal that we've got, the big, hairy, audacious goal, the Everest mission, is basically to get our group of companies. We're looking to get to 100 million. And then the aim for that as well is just to reinvest as much as possible into property, build that asset base up. The accountancy business, we want to be known as basically the number one go-to accountancy firm for property tax. So whenever anybody's thinking of, okay, I'm a property investor, I need accounts and tax doing, there's no doubt in anybody's mind that, you know, you're working with JSM. That's where we're looking to get to from that perspective. And then kind of on a personal level, it's just kind of travel as much as possible, have fun whilst I'm doing it, and just live a good life.
Love it, mate. Really, absolutely love it. I'm going to continue to follow your journey as well and watch you get there. Is the plan to get these offices, satellite offices, to the whole UK, worldwide, Europe as well?
Probably not. Before that is because I don't really like being in office all day, every day. So as soon as you start doing that, then I've either got to basically find somebody to manage those offices, and then they need managing as well. So I want to try and build that as light as possible. So whether that's actually, you know, most people working from home, one central hub, utilizing kind of overseas staff as much as possible, I want to kind of build it in such an efficient way that, one, it's the most profitable for us. And, you know, having these large offices with people being in there, that's costly. So we want to try and utilize people working from home, and then having one central hub, probably in Peterborough still, where, okay, if people we do need people in the office to do things, answer phones, and that kind of mail processing, that side of it, we've got that. But yeah, absolutely keep it as light as possible. Based in Dubai as well, but yeah, certainly not throughout the UK.
This is something that must be very achievable now in accountancy industry that wasn't before, due to the making tax digital and all these kind of, you know, zeros and your online.
100%. It's more achievable than ever. A lot of firms actually outsource the account side of it and the tax returns to India, the Philippines, because everything's on zero. You've got all your information is digital. So actually they upload it to a platform, and somebody in India actually does the actual legwork in terms of making the accounts. They can do that for £5, £6, £7 an hour. And then it comes back to the UK, gets checked, gets sent out. That's what's possible now. And especially with accountants, as long as they've got a laptop, they can work anywhere around the world. So you can literally give them, even on a freelance basis, okay, yeah, do these accounts. You've got 100 client sets of accounts to look after. As a kind of a client, you don't really know who's doing your accounts. You just know who you're speaking to get tax advice now and then. So that's the kind of way that we might be looking to scale it, and actually we're utilizing freelance people across the UK, giving them the work to do. So, you know what, you've got to do these for you to make sense in our business. Just do these 150 sets of accounts a year, then we're going to make money off you. And then just like kind of leaving them to it almost.
Yeah, no, that's absolutely makes sense. And I love the vision, mate. Really look forward to seeing you grow it and take it on, go for it.
Appreciate it.
So I hope you guys enjoyed that interview, and as always, really appreciate your support. Get over to Eventbrite, book your ticket on one of our in-person live networking events. We're really enjoying building the community on the Scottish Property Podcast, guys. And yeah, follow us on social media.
Thanks a lot, guys.